Well, the last time this guest joined us, he suggested moving away from cyclicals to a more balanced portfolio that included some defensive names. He's overweight the U.S. and emerging markets and underweight Europe. Jeff Palma is the Chief Global Equity Strategist at UBS Securities, joining us from Stamford, Connecticut. Jeff, great to have you back on the program. See you again.
Good morning, Betty.
Let me start off with those comments that we just ran of Bill Gross, right, where he says, look, equities are pretty much on their own now because the Fed can't lower rates anymore. What do you make of that?
Well, I think that's always the case. I don't really think that the Fed has been trying explicitly to support the equity market here. Bond yields are low, and I think one of the challenges for equities is that low bond yields are reflecting a pretty tepid growth environment, or at least an environment with a fair amount of risk. And that's why we haven't necessarily seen equities rise over the course of the last couple of weeks as bond yields have fallen.
Right, but I think, it's a good point by Gross, though, in the sense that, even though the Fed is not purposely trying to fuel the stock market, QE2 was kind of in tandem with this rally we've seen, right, since late last year. And now with QE2 ending, people are saying, well, where do stocks go from here then?
Yeah, but I would argue that the most important factor for equities over the course of the last 6 months has been the improvement in economic data that we've seen. If you remember last summer, we were talking about soft patches then as well, risks about double dips. As those fears eased, we saw equity markets rally. Yes, that coincided with QE2, but equally, we saw that improving economic data. I think not surprisingly, as economic data have surprised a little bit to the downside more recently, equity markets have also struggled.
Right, and exactly, and they've been in correction mode over the last 6 days. Because of that, Jeff, would you be bailing out of more cyclicals and going into defensives then?
Well, I think we're at a stage in the cycle with tactical risks notwithstanding, a more balanced allocation across cyclicals and defensives is warranted. It's our view that we're in a more mature stage of the cycle where a lot of the tailwinds to earnings growth are behind us. That suggests that the best news on cyclical sector outperformance has passed. Tactically, yes, to the extent that we are in a correction phase, cyclicals are also going to struggle in this move. But I think that it's not just about tactics here. It's really the same sort of strategic position that we would recommend.
Okay, so defensives you would recommend, though, those same sectors that you talked about last time then, right? Technology, I think it was, industrials as well?
No,
not industrials, I'm sorry. I know technology, healthcare, right?
That's right. So technology is the cyclical sector that we still like here, given strong business spending support. But healthcare and telcos we've liked for some time this year, mostly because of their valuations. We think that there's some supportive factors to growth and also profitability in those sectors.
Okay. Emerging markets, something else that you like as well, something that you're overweight in. However, yesterday we saw a spike in oil prices. How much is that of a bigger risk now to the emerging market story?
To be honest, I don't think that the spike in oil prices is any more dangerous for emerging markets than it is for the developed markets. In fact, you might argue that the rise in oil prices is more dangerous for the global economic recovery to the extent that developed markets have had a more fragile recovery. It might be worse there. Emerging markets have struggled this year for lots of reasons. I think it started with inflation concerns. Maybe it's moved to growth concerns. In the end, we like the growth prospects in EM, and we think that valuations are pretty attractive there.
What about valuations in Europe? They've got to be attractive enough now, Jeff, to want to put some money into the European markets.
I think on a regional basis, European valuations look as good as they do anywhere in the world. That's fair. I think, though, that the challenge from my standpoint is that they reflect a fair amount of risk. They reflect risk to the financial sector emanating from the sovereign debt worries. They reflect risks to the growth environment because of the peripheral economies. But I think what's worth saying here is that within Europe, there are some pretty good opportunities. The core of Europe, Germany in particular, has been very, very strong. The growth outlook, the export sector there has been good. I think we can pick and choose where we buy within Europe, but I think as an overall market, moving to an overweight position here is still challenging given what confronts us on the sovereign side.
So does that mean, Jeff, that the big issue then, if you want to get into Europe, is timing, right? It's timing that market.
I think that's right. If we're right that the global economy is in a sustainable recovery and ultimately Europe is able to resolve some of the sovereign debt worries, it's going to be a great trade to be into Europe. You're going to want to own those parts of the market that are most exposed to a recovery phase. I just think we're not there yet. It's too soon. All
right. Jeff, good to see you as always over in Stamford. Jeff Palma, the Chief Global Equity Strategist at UBS Securities.